tool to model your financial future. My name is Gary Mishuras. I'm the managing partner and chief investment officer of Silvering Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I've used the wealth simulation tool several times, including the freedom webinar that many of you participated in. And I just wanted to dive in a little deeper and show you how I actually use it. I'm going to switch to my screen and just walk you through it. Bear with me here. All right, so what we have is the basic inputs that we're going to use. We have the number of iterations. That's how many times we want to run the Monte Carlo simulation. The number of years that we are forecasting for. The starting amount of money that we have. How much we're planning to withdraw per year. The expected rate of return per year. And the standard deviation of annual returns. So just to kind of frame everything, the goal here is really to figure out what's the likelihood of you running out of money before the end of the period, given that assumptions that we're using. And I think it's important to use this approach, which is the Monte Carlo simulation, which is basically drawing from the same probability distribution many, many times to figure out how, under different scenarios that the world can take, you're going to do. And that's different from a lot of online calculators that people use, where they just assume that there's essentially no randomness in the world. Unfortunately, there's plenty of randomness in returns, and you want to make sure you understand how much risk you're taking if, say, you're retiring or counting on your money for something else. So these are actually the assumptions I've used in the first scenario I talked about in the Financial Freedom webinar, which is if you have a typical 60-40 stock bond portfolio, this is not far from the average rate of return I would expect you to have for the long term. This is going to sound low to many of you. So if you want, check out the webinar replay where I explain the details of how I got to this number. But you can play around with your own assumptions. And if you send me an email, I'll happily send you the wealth simulation tool for you to use for your own purposes. Now, I'm going to show you what the output is and how it looks. So we're going to go to this tab right here. And this is what the output looks like. What this tells you is that 5% of the time you're going to run out of money, and 95% of the time you're fine. And that's kind of what we were targeting in the simulation, to figure out how much money we can take out so that we have no more than a 5% chance of running out of money. And the way to interpret this graphic here is that if you reach 30, that means that you're good. 30 was a target length of time, that you're good until the end. However, some of these scenarios, you run out of money sooner, and these bars here show you when you run out. So maybe you run out of 20 years, you run out of 25 years, and so forth. So this kind of shows you the distribution of different outcomes over many, many iterations. So let's go back to the inputs. I'm not going to run this for 10,000 scenarios because that will take a long time. I pre-ran this for you. But let's take a look at a smaller number just to see what it looks like. So I'm just going to put in 300, which is a fairly small number. And let's say what would happen if you wanted to withdraw 5%. And let's say you didn't believe me and said, well, I'm going to take 5% of my money out, even though these are going to be my likely return. So I'm going to hit run. It's going to run for, give it maybe 15 more seconds or so. And then we're going to go to the output tab, and you're going to see what happens. And you're going to see the results of what it will look like. And you're not going to see the full graphic because that requires full 10,000 iterations. But you are going to see, 300 basically. So here you go. You have 300 iterations, and that means you ran out of money 62% of the time. So that's small change. So look at what we changed. We went from taking out money 2.7% of the time, which is what we said is the safe withdrawal rate for these assumptions, to taking out money 5% of the time, which is almost double. So it's a meaningful difference. And voila, most of the time you actually run out of money. So you can use this tool in a number of ways. You can figure out, okay, given my starting wealth, how much can I afford to withdraw? That's one use of it. Another way to use it is to figure out how much money do I need in order to meet my fixed expenses. If I want to retire and say I want to have a certain amount per year in fixed cash flow, this can help you figure out how much you need to start with as far as wealth. I hope this is helpful to you guys. If you like this video, please hit like and subscribe to my YouTube channel. Thank you.